Robschild, no investment advice. Welcome to the show where we view financial markets using Ben Graham's investment philosophy, macro, technicals, and crystal ball gazing. Today is Monday, October 28th, 2024. Today's episode, we're going to start by talking about the fact that there is huge earnings this week. Big week of earnings. To see this for yourself, you can check out Earnings Whispers on X, or previously Twitter. Very notably, we have some major mega cap companies like Alphabet, Meta, Amazon, Apple. We also have Intel, we have Microsoft, we have PayPal, we have cereal, we have tobacco, credit cards, Chipotle, just a humongous amount of majorly important earnings coming out this week. I love how they organize Earnings Whispers organizes this information in this schedule here. Tomorrow, Tuesday after the close, Wednesday after the close, and Thursday after the close are the times to be that could really rock things around. These companies have ginormous amount of market cap, which can affect entire indices and market expectations for business in general. So watch out for that. Not only do we have huge earnings this week, tomorrow on Tuesday we have job openings, which could also potentially rock things at 10 a.m. On Wednesday we have GDP. I believe this is the first reading of quarter three. So this is also hugely important. For example, if this were to be negative, that means, guess what? We actually are already in a recession. I have no idea what it's going to look like. And then Thursday we have PCE. This is the personal consumption in expenditures. This is the Fed favorite as far as the inflation gauge goes. So that comes out on Thursday. And then Friday, another unemployment report. What is the percentage of people in America right now that want a job and can't get one? That unemployment number is really the biggest defining factor in the way that we typically define what a recession is, right? You have people out there that want work that aren't getting it for whatever reason. And it typically leads into a lot of bankruptcy and the need for the Fed to lower rates, for all rates to go down if that starts going up, as I expect it to, either this report or some report within the next 3 to 6 months at the maximum at this point because of where we are with the yield curve. Nothing has changed in the daily reminders. If you want to hear an explanation of walkthrough of all of these things, watch Monday's show. The only thing that we may add to it soon is the 3-month 10-year uninverting. And actually, when we take a look at the 4-month, for example, to the 20-year, if you haven't seen it, hold your hat. I suspect the 3-month 10-year anyway will be added to this sooner than later. Again, no other changes. The crystal ball reading remains bear market very soon, and the Fed won't cut fast enough to save the economy. I recently received a very generous donation. You know who you are. Thank you very much. And for the rest of you, feel free to support the channel any which way you please. So let's dive straight into the charts. We're going to start with the U.S. Treasury's yield curve. I mentioned the 4-month 20-year. As you can see, the 4-month as of today is 4.65 and the 20-year being 4.61. That is a 4 basis point spread between the 4-month and the 20-year. If this isn't a reversion or uninversion, as most people like to call it, I don't know what is. We're there. We're basically there. Again, the main one we want to look for is the 3-month and the 10-year, which have a larger spread currently. But as we get the next cut and we have more expectations, the 3-month treasury is 3 months from today. And every day that passes, we get closer to, 3 months in the future, which, the market will be pricing whatever more cuts will be coming within that time frame. At this point, I believe it would be highly unusual for the 3-month not to drop below the 10-year within the next few months. First stock chart of the day, the S&P 500, not really showing much movement. For the most part, you have to take any kind of movement in US stocks in particular with a huge grain of salt. Considering how much major reports there are, earnings reports coming out this week. I mean, tomorrow the job openings could rock things, but really the fun starts after the close on Tuesday. So Wednesday is when things really kick off, because of the fact that, on Tuesday after the close, we have AMD, Alphabet, Chipotle, Visa. That's when it really starts, along with all this other data coming out. Tuesday, Wednesday, Thursday into Friday. It's going to be a wild week. So today in the S&P 500, we're just floating sideways, waiting to see what'll happen. By the way, I'm trying my best in these shows to present the charts that I think are the most important to look at, generally earlier, and getting slightly less important through the show. Although, if you're wondering what order I choose to put the charts in. So one of the more important ones that I think is good to bring up today, again, is the 10-year break-even inflation rate. This is the market that prices inflation for expected inflation for the next 10 years. Today, what is the market pricing will be inflation for the next 10 years. I have been mentioning how we've been going up and up and up, all up until about October 10th. And then since then, we dropped and we've been really going sideways. And again, today, further cooling off to 2.29% expected inflation rate over the next 10 years, averaging. With the 10-year note yield and longer treasury yields rising, people are sometimes talking about how this is like, it's inflation. People are worried about inflation. It's like, okay. The market, we went from a low of actually 2.02%, up recently to 2.3%, but this is not it's not 3%, it's not 4%. There's no real worry here in being priced yet, even though longer yields are going up. Again, when yields go up, the problem fixes itself. Higher yields create lower yields. Higher yields create pressure on inflation to go down. That's how it works. It's a natural functioning market. Yes, we have the Fed in the front end of the curve, trying to help the situation, but the Fed does not control the longer end of the curve. And the longer end of the curve, it's controlled by you and me and institutions and other countries and everybody. The market prices it. And the market is pricing today inflation rate of 2.29%, whether you like it or not, whether you believe it or not. I'm in the camp that it'll probably be lower, and plenty of people are in the camp that believe it will be higher. So we'll see how it plays out. Again, if you ever want to check what is the market pricing for inflation, this is the chart to look at, the 10-year break-even inflation rate. With massive earnings coming out this week, along with massive data coming out this week, along with, the election right around the corner, there's a lot of stuff going on. Turbulent times in markets. Obviously, it makes sense for the VIX futures contract to be elevated across the rest of the curve. I mean, who isn't expecting volatility here? I know I am. with all of this potential high volatility coming, the credit spreads are not afraid here at all. And I believe they should be. Again, so this is the spread between AA corporate bonds. These are high grade bonds. This is the debt that big companies owe. It's how much they have to pay above the Treasury rate, which is guaranteed. And it's only 0.48%. Again, in crises, like during the Great Financial Crisis, this widened to almost 5%. And then afterwards, in 2011, we had a period of 1.93%, COVID 1.8%. It rarely gets to 0.48%. If we try to find the lowest spot, for example, between, I guess we could say around 2000 all the way through maybe 2020, really, over a 20-year period, we had gotten to 0.45 in April of 2004, and we had been in around that range for a few months. Is the only period in a 20-year period where we were that low, where credit spreads were that tight, where the market had priced just zero chance of bankruptcy, basically. Or it's not even bankruptcy, really. It has to do with defaults of payments and even being late one day in bond markets, which are massive. It's an expensive loss. What it says is that people are willing to take on, a larger amount of risk just for a little bit more yield that, you can get on corporate bonds. I have a feeling that unfortunately a lot of, people with financial advisors are perhaps when people are asking to be at least my theory is that when people are asking to be put in bonds, they're being put into corporate bonds. And that's sort of what's driving this to get so tight. There's a lot of money going into corporate bonds versus treasuries. That's how you can get this such a tight spread. And again, the implications of that is that we're pricing in like no worries here. I do not believe it's a good time to go into any kind of corporate bonds right now when they're relatively expensive compared to treasuries. I think it's a good time to get treasury bonds. I don't think it's a good time to get corporate bonds. And the market's doing the opposite. It's loading into corporate bonds and actually not putting enough money into treasuries, comparatively. So that's what I think is going on here. But, remember, I'm just a guy with a crystal ball. Junk bond spread is also historically low at only 2.89%. Very, very tight. Not really pricing any risk here, or much less risk than normal. Junk bonds and all corporate bonds often go on major discounts. And right now, there's no discount at all for these bonds. This is why I hold a lot of put contracts on the junk bond fund HYG and LEAPS. They're still options, but I have them over a year. Actually, I have one contract that's, it's over a year dated out. Moving on, we have Bitcoin popping clearly higher, clearly closing above any kind of signal before. Good chartists are calling out that we're headed to the $74,000-$75,000 range at the moment. For people that want to get into this market now for where we are with the earnings and all the stuff coming up and the elections, it's like, maybe people could treat this maybe even validly as a, run to some sort of safety, outside of the dollar, if they're worried that the dollar is going to be collapsing here. I don't think it's going to be collapsing, but that might be the idea that that could potentially drive Bitcoin maybe straight up to the $100,000 range over the next month or two. But I can't I can't. I can buy stuff when it's on discount. I won't chase momentum higher. As I've mentioned, and everyone's talking about, the 10-year Treasury Yield still headed up to that ultimate line. Again, I'll scroll out again. I do this every show because it really is this important. We have this top in March of 2021, meeting up with a bottom in May of 2023, forming a major head and shoulders top on the 10-year yield, breaking and the neckline, and now retesting. It would be highly normal and expected for this to run up to the line and get majorly rejected off of it around 4.38. At that point, I will be putting the rest of my own cash into a fund called TMF. It's leveraged long duration treasury bonds. And at the moment, that will bring my portfolio up to something like 60% in long duration treasuries with leverage. I'll probably get some call contracts on that too. If you were watching oil at all today, especially early this morning, you noticed that it was down like 5%, a pretty large move down. We recently have, since then we've rebounded a little bit, but we've broken some trend lines and it looks like we are headed lower. One chartist I follow is expecting to get down to the $50 range this year per barrel in oil, even though his own chart says we're actually headed to about $35 a barrel. I think it's more likely that we'll get to that $35 a barrel mark than he believes, because I believe because of the fiscal dominant situation, monetary policy cutting rates is not going to be as effective. Just like the hiking cycle wasn't as effective, the cutting cycle won't be as effective. Not enough people are realizing that part of this. They think, oh, we cut too fast and that's just going to light things up on fire and the market's just going to go to the moon and inflation's going to take off again. It's like, it just doesn't work that way. When things are slowing down, they slow down, and it's a ship. Once it starts turning this way, it's like you turn the wheel. It doesn't just start turning the other way. It has to finish turning this way before it's like, oh, you want it to go the other way, and then it starts going the other way, like steering like a big ship. It's not a little ski-doo where you turn this way and it immediately turns around. Go-kart's probably a better example. That's not what the Fed does. The Fed's driving a ship, not a go-kart. But I digress. Main thing is oil. It looks like oil will likely head lower in the near term. Again, this is also on the back of tensions in the Middle East cooling off a little bit, allowing oil to cool off still. Notably, you have this divergence, by the way, of the 10-year yield really going up while the oil is showing weakness. Yields typically follow oil. Oil's going down. Yields are pretty set to go down. We'll see if the stars align and we get to that 4.38 in the 10-year. It's pretty much in the stars right now that it's going to play out exactly that way. Hit the 438, tank. But remember, I'm a guy with a crystal ball. What do I know? K-Web, Chinese ETF, the ETF that holds Amazon, Facebook, all the other and internet companies of China, the Chinese versions of those, like Baidu, JD, Baba, all those companies. I mentioned on Friday's show we were coiling up in this very clear little wedge thing. We popped right above it today. I expected we would pop higher. Again, I think that this market in general is still extremely undervalued. Still undervalued at the $45 to $50 range, just not blood in the street cigarette, but cheap. So that's what I'm gonna sell. We'll see if we get there. I don't know when we'll get there. I don't really care. I'm holding it as an investment until we do get there. EWZ also a majorly undervalued equity market. Brazilian equities, insanely undervalued. And if you take a look at and zoom out of the chart, you can see this massive wedge pattern going back to 2011. We haven't. That's just been going down for a long time. This is as far as chart patterns and valuations go. This is majorly dry powder in my opinion. But anyway, on a short term basis, we recently kind of broke higher out of this little wedge looking thing. Brazil supplies stuff for China too, and so their markets are tied together to some degree, and so especially just as emerging markets, and especially as money tries to figure out where to go, as it wakes up to the reality that the S&P 500 is massively overvalued. And it'll be a rude awakening, I think, this week with the earnings coming out of these major companies. I mean, for the valuation of the S&P 500 to make sense, the earnings have to just they need to blow expectations out of the water. And if they don't, if the market smells out any, not weakness, but any like slowdown of strength, we're headed for a major correction, in my opinion. Last chart I'm going to bring up today is SMH. Again, I have SOXS. It's a triple short of SMH. We have AMD having their earnings come out after the bell on Tuesday, and I think that might be the real kicker that gets this thing to drop. Chart pattern wise, we've just had all of these massive engulfing candles at these peaks of this very perfect looking head and shoulders top, along with a double engulfing candle at the very top here. This is just the most bearish setup pretty much ever made. With this recent bearish engulfing candle on the 15th of October, just flagging out, really waiting for AMD. I think AMD will most definitely crack this line to the downside, head to the neckline, and I believe we are going to break the neckline too. I think that from the top we are destined to lose at least 50% of the value of this industry. It's reminiscent of the dot-com bubble, the railroad bubble, a lesson that Wall Street, well, at least we'll call it the market, a lesson the market tends to never remember is the fact that trees grow tall and they don't grow forever. And that's all for me and my crystal ball. Hope you enjoyed. Thank you for watching, and see you next time. Robschild.